Well, it was pretty oversold in October, I guess, so bounce was inevitable. There has been, I think, all year for my side of the fence, the bond deniers, the bond yield will fall, recession is coming, a year delayed yet again. I always use the analogy of the American consumer and the whack-a-moles keep hitting and they still pop their heads back up, and they miss, and Black Friday they've proved the point again. And I think people miss the point. People have got real income growth in many cases. They've got pandemic savings still there, and the Americans created an enormous boom in the pandemic. The money supply growth was through the roof. They created a boom. We are still feeling that resonating through, I think, the marketplace. And the bottom line was in October, it was very oversold. And it was. You were clipping away and you'd taken about half the gains or something. So I think you've had a strong rally. You got to 5%. Ackerman and co decided that was enough. They turned tail. Bond yield falls. Market rallies. Away we go. I've said to you on this show for a year, most of the managers I talk to, fund managers, are fairly constructive. I would say the value guys in aggregate have been better than the growth guys. Got that completely wrong in America, of course. I'm guilty of that too. I did say stay in the market, but I didn't say buy the Nasdaq. But I think it's that idea that it was deeply oversold last year. There's a lot of scepticism that we can carry on moving forward. And investors have got... they have got a lot of cash. Some of that is a switch into money market funds because of interest rates. I know that. But... they're on the sidelines. They want to get engaged and involved, and they've been showing their colours, and they want a Santa Claus rally. I mean, there's no point denying what's obvious. It's there, and people want to participate. For next year, we'll see.
It's been a monster rally on the S&P as well, not just on the Nasdaq, right? And you can see it on the curve. Yep. But what happens from here? Because markets tend to move ahead of what you're seeing on central banks, and there is a view that even from April we could see some rate cuts. Are you saying that you don't think it's going to happen?
That's absolutely. I heard you and Steve to bonkers. I mean, rubbish.
So
sorry, I'm going to say point blank rubbish.
So when is the first rate cut?
Well, I think there's. I think Powell and Co. What does he want to be, Volcker or who's he want to be, Burns or Volcker? Choose.
So you're saying the former cut too early, the latter was more robust in his facing down of inflation.
He faced a much bigger peak, admittedly, handed off by Burns. So the point being that there is no evidence the Fed needs to start cutting. The market's pricing that in today, aren't they? And I think that is probably what I mean about 24. The idea that we get the Goldilocks, which is what we're actually pricing in today, aren't we? Let's be honest, we're pricing in lower inflation. Earnings have actually been fairly resilient. Revenues have been okay. The magic game of earnings adjustment downwards by the Americans, as they always do so well to manage our expectations, has been met. But as you move into 24, the idea of rate cuts, as you say, April, even into June, isn't it? All the way through, rate cuts all the way through from April. I don't think that's realistic. On the other hand, I would cite the average bond manager I talked to. We're doing our bond manager reviews right now. Most of them expect slower growth and falling long bonds. They would say that. By the way, I don't agree with that either. I think they're wrong, and I do think they're wrong. I don't think the 30-year in particular, but I don't think the 10 years is going to slide. I don't think the economy is that weak, and I think more importantly, you're building a term premium in to the medium to long end of the yield curve. Governments keep spending money. I'm not giving them money for 2% if I'm an investor. Why should I? Break even says 2% inflation. I don't believe that, nor am I going to give governments money at 2.5%, because I'm not, and I don't think any other investor's going to. So I think you get a normal curve. You get a short end, which responds to the economy, and I think the longer out you go, the more you build that term premium in.